Hey there, Jim Brees here from Green Growth CPAs, and today we're going to talk about a tax court ruling that could impact your cannabis business. Now, what we see quite often is that there are many cannabis businesses that are set up such that they have a management company to help operate the dispensary or their manufacturing facility or even their cultivation site. Now, in this video, we're going to unpack and understand the tax implications of doing so and understand, is this really a good strategy for your cannabis business? Now, we'll explore all that and more. And if you have any questions about cannabis business taxes, then please reach out to us via our website at greengrowthcpas.com or give us a call at 800-674-9050. Let's hop right into the presentation.
So today's topic again is a case study of alternative healthcare advocates and cannabis management companies. My name is Jim Brees, the Chief Marketing Officer here at Green Growth CPAs. In a recent court ruling, an alternative healthcare advocates versus the Commissioner of the Internal Revenue Service offers some significant tax implication for cannabis operators like yourselves and management companies. Now, the case, which was filed at the end of December 2018, is a cautionary tale for any cannabis operator who partnered with a management company to help run their business while staying compliant with 280E. Now, management companies are a common strategy that cannabis business operators deploy to save on taxes, but is it really helpful? So let's hop right into that. But before we do, I need to let you know that the information contained in this presentation is meant for guidance purposes only and not as professional legal or tax advice. And further, it does not provide any personalized legal, tax, investment, or any business advice in general. So with that out of the way, let's review what we'll cover today. So first, I'm going to explain to you what the management company strategy is and why companies deploy this strategy. Then we'll talk about what happened in the alternative healthcare advocates case. We'll discuss some key takeaways and show you an illustrative example of the financial implications of this case, and then discuss some lessons learned and things you can incorporate into your cannabis business. So the management company strategy. You may hear this thrown around here and there. You may have heard your lawyer talk about it, maybe even one of your CPAs talk about it. So let's break it down so you really understand what this is. And this was very common in the early days of the medical marijuana business and the medical marijuana industry, especially in California. So what this is there's two separate legal entities. One that touches a cannabis plant, which is essentially either a dispensary, a cultivation, manufacturing, potentially a whole vertically integrated business, and then one entity that helps, quote unquote, manage the cannabis business. And you would think of this as a consulting firm, essentially. And they handle things like overseeing HR, advertising, hiring, payroll, things of that nature. And some business owners and lawyers implement this strategy for a few reasons. The two main ones are to mitigate the 280E impact by offsetting disallowed expenses to the management company. And secondly, to gain access to banking and merchant processing. So merchant processing is essentially being able to take debit and credit cards, which can then really increase your revenue as a cannabis business. Now, does this really work? I would say rarely, if ever, especially if two things pop up. One thing you're going to see common in these cases that where they gut the company and just pretty much hang them out to dry is if the same ownership is at the management company and the cannabis touching company. And if that management company only manages one dispensary, especially the one that they just own. When you see those two things pop up, it's going to be disallowed and the government's just going to go to town and pretty much disallow everything or say that the management company is trafficking, which brings me to my next point. If one entity is trafficking a Schedule 1 or Schedule 2 controlled substance, then the other is as well, especially again if there's that intermingling of the ownership and they only manage that one dispensary that they own. And what brings even more issues is that that management company is then concealing that the funds are from cannabis in most cases, and then that equates to money laundering, which can open up a whole new can of worms, something I'm not going to explore in depth today, but you can speak with your legal counsel about that. It can become a very, very big problem. So that's the management company strategy. Two legal entities, one touches the plant, one manages that cannabis dispensary or whatever that cannabis touching business is, and then they do all these different strategies to help mitigate 280E and get access to banking. So now that you understand that management company strategy, let's look at what happened in the Alternative Healthcare Advocates case. So Alternative Healthcare Advocates is a nonprofit mutual benefit corporation based in California at the time of this case, essentially a nonprofit organization. For tax purposes, this business was classified as a C Corp. Now, Wellness Management Group provided management services to Alternative Healthcare Advocates, and these management services included things again like managing HR, paying for advertising expenses, things like weed Maps or Leafly, hiring, payroll, things of that nature. And Wellness Management Group was taxed as an S corporation. Now, these designations are going to be important because an S corp has flow-through income or pass-through income to the shareholders, and will illustrate how that actually hurt the shareholders once this case actually shook out. Now, in this arrangement, Wellness was paid by alternative healthcare advocates through fees for its services. Now, again, this arrangement of a management company is not unusual, and many cannabis operators partner or set up management companies to mitigate, again, the impact of 280E. Now, as a refresher, if you don't know what 280E, we've talked about it in great depth and great lengths, but 280E bans any business that traffics a Schedule 1 or Schedule 2 controlled substance from deducting business expenses on their federal tax returns. Now, cannabis is still considered a Schedule 1 substance at the federal level. It may be legal in your state, but again, in most instances, state licensed and legal cannabis businesses cannot claim those normal business deductions like payroll, marketing expenses, rent, things of that nature on their federal returns. But what you saw in 2019, in 2018, some states passed legislation to overlook or not impose 280E at the state level, and a state like that is California. They passed that last year. Now, cannabis companies may partner with management companies to avoid tax responsibilities under 280E, but there are other reasons, again, for setting up this arrangement. The biggest benefit is access to banking and payroll services, regular payroll services. If you've run a cannabis company for the past 5 years, you know that there's a lot of issues where you hold a lot of cash and you have to pay your people in cash. You can't do a regular ACH direct deposit for your people. You can't give them checks because there's no place to bank with it. So that is one of the main benefits of partnering with a management company. Now, management companies offer cannabis operators an avenue for essentially operating a semi-regular business while staying compliant with 280E. Now, where the arrangement can really shoot you in the foot and just explode in your face is that if the management company is seen as trafficking cannabis. Now, this happens when the management company introduces new transactions to the system involving the same set of money. Okay, essentially what's happening is all those offsetting expenses that you give to the management company, they get taxed twice at the dispensary level and at the management company. And again, if you're intermingled, same ownership of the dispensary and the management company, again, you're going to get hit really hard. But in this case, the court ruled that Wellness's business activities were essentially inseparable from alternative healthcare advocates, right? They depended on each other. Without alternative healthcare advocates, Wellness's business would not be there at all. They would have no revenue. They would have nothing. So let's read a direct quote from the actual filing. Wellness employees were directly involved in the provision of medical marijuana to patient members of Alternative's dispensary. While Wellness and Alternative were legally separate, Wellness employees were engaged in the purchase and sale of marijuana, albeit on behalf of Alternative. That was Wellness's primary business. We, the IRS, do not read the term trafficking to require Wellness to have had title to the marijuana its employees were purchasing and selling. That is a very important term right there. Title. They do not have to take on ownership or title or inventory of that marijuana, and they're still being implicated in trafficking marijuana. So in short, it made no difference to the court that Wellness and Alternative were two separate business entities in a contractual agreement. Wellness, the management company, was still claiming tax deductions that essentially violated the 280E regulation and therefore committed tax fraud. Now, I brought this up earlier. I really want to make it very crystal clear. One last important nuance to this case is that Mr. Duncan, one of the Wellness shareholders, which is the management company, only offered his management services to one cannabis dispensary, Alternative Healthcare Advocates, which was his dispensary. He had some vested interest in it, even though he had anticipated that Wellness, the management company, would offer their services out to other dispensaries, right? He only gave this service out to one dispensary, the one he had, vested interest in, and without providing these management services to another dispensary in the 5 years that Wellness was operational, they sent a nearly clear signal that this management arrangement was simply for tax purposes only. So that's the case in a nutshell. The businesses were inseparable. They were both trafficking cannabis, or were said to be trafficking cannabis because they were inseparable. And this was just a tax strategy. No other dispensaries are supported by Wellness, and there was some fallout from that. So let's look at some key takeaways from this. First, the main thing that we want you to understand is that the management companies were subject to 280E. Now, structuring your company as an S Corp or a C Corp does not seem to have any measurable impact on the court's opinion in these management company cases. So if you're trafficking or managing a company that is trafficking, that entity, that management entity, is likely subject to 280E and all of its restrictions. Secondly, I want you to understand the shareholders of the management company get caught holding the bag, and that will likely be you listening to this video or to this podcast. So if you are operating a dispensary and you have a management company with some intermingling, inseparable interests, you're going to be left holding the bag. So in the Alternative Healthcare Advocates case, the S Corp management company, right? I brought up S Corp. It's very important you understand this was an S Corp, but here's how you really get handed that bag, holding it, and it's really, really heavy because there's a lot of tax implications. The S Corp management company, which is Wellness, filed taxes on March 15th and wrongly assumed that 280E doesn't apply to them. Now, in their tax filing, Wellness deducted a ton of expenses that they ultimately were not allowed under tax code 280E. What this did was reduce the taxable base of the shareholders and ultimately created an underreporting of their flow-through income. S Corps have flow-through income. If you take all those expenses that you think you can take, and then later down the road, the tax court says, hey, you can't take those, that's now an underreporting of your flow-through income. So I know there's a lot of things flying around here, so let's look at a visual example to help you better understand. So on the screen here, you see two entities in green, right? On the left-hand side, you see a dispensary, C Corp, Alternative Healthcare Advocates. It's this case here. And then on the right-hand side, you see Wellness Management Corp, which is the management company, and it was an S Corp. So now in this case, we're not going to look at the dispensary. Essentially, the dispensary had no change in issues. They followed 280E guidance, and they did not take any of those deductions that were going to be disallowed, so essentially no change. But on the right-hand side, you see Wellness. So let's just walk through a basic. I don't want to get to the specific numbers of their income. I want to keep it nice and round so you understand. So say that Wellness Management Corporation had $1,000 in total income. Now before the audit, before this tax case, they said 280E doesn't apply to us. So that's designated as no 280E. Now what they said is that we had $100 in net income because they had 90% expenses. Now let's assume that there's three equal partners here. They had 33% interest, so they each have $33.33 in pass-through entity income. Okay, so that's designated at the bottom there, 33.33 for each of the three partners. Now, after the audit, the tax court said 280E does apply to this management corporation, and you have no expenses, everything's disallowed, and you have $1,000 in income, which then essentially makes everyone go up 10x, right? So each partner in the firm that has 33% interest now has $333.33 in pass-through income. Now, what this does is it illustrates that individual shareholders in particular will be hit hard for underreporting their income. Now, the management company model hurts the individual shareholders of the management company more than the cannabis business itself. So you have to be very thoughtful. When you start to underreport income, you're going to have a lot of issues, which we're going to walk through in the next slide here. So the lessons learned from this case. So how do you mitigate all the risks that came with this management company setup and this management company strategy? So first and foremost, get professional tax advice that is backed by experience and tax court rulings. Now, I'm sure that Alternative Healthcare Advocates did have legal and tax advice for this strategy, so let me explain further. Do not try to bypass or bend the laws in your favor by trying something new or creative, any strategies of that nature. It may work for 1 year or 2 years, but if it backfires, it can be extremely painful and costly. You want to work with a CPA that has experience in the cannabis industry instead of just working with your local generalist CPA, right? Your local generalist CPA may see, oh, there's this thing out there called the management strategy. Let's do that. It seems like it's going to work, right? There are so many little nuances to the cannabis industry and all these little court cases. Not little, they're actually very, very large and impactful. But those court cases and those nuances, your local CPA may not be aware of them or the implications of 5 years down the road for doing those. Now, you don't want to push the envelope too far. Cannabis is still federally illegal. The IRS is a federal organization, and they will use all the power that they need to make sure that they get all of the revenue for them, right? They're called the Internal Revenue revenue service. They're trying to generate revenue for the federal government. Just because you came up with some tax strategy that looks legal on paper, their job is to find more revenue for the federal government, and they will, in most cases, get what they want and get what they desire. So work with a CPA that has experience in the cannabis industry and that doesn't bend or break rules so that you feel cozy for those first 2, 3, 4, 5 years. Now, the second lesson from this case is that you need to create and save detailed documentation for your business from day one. And this is because there's something called the statute of limitations, especially for auditing. Now, typical audits are given a 3-year window. The IRS can send a letter and say, hey, in the past 2.5 or 3 years, we see some, discrepancies in your tax return. Let us know some more information about this line item or this line item. But since this is a large understatement in income, the IRS had 6 years to start this audit, right? They just send that first letter, and that's like a pin in the ground, and now they've kicked off the audit. Let's go ahead and start this. They are within that statute of limitations, but I want you to understand this timeline is not set in stone by any means. With fraudulent tax returns, there is no statute of limitations. It's forever. The IRS can come after you in 15 years if they'd like. But in the alternative healthcare advocates case, the IRS showed that it can trigger that audit within the 6-year window and then take another 3 to 4 years to conduct and complete the audit and the corresponding court cases that come along with it. Now, the risk is that this accrues more interest and penalties for you that the longer the case drags out. And with little to no documentation to help your CPA or lawyer reconstruct your financial records, your audit will drag on longer than necessary. And when I say longer, I don't mean 2 weeks or 2 months. This could be 2 years longer or 3 years longer or 5 years longer. And all these different appeals that you do, right, because there's some discrepancies and all the motions that come along with the case, it can be extremely costly. We're not talking about simple interest, we're talking about compounding interest and penalties. So to build on this, as you saw, when the IRS goes back to calculate your tax liability, it adds up quickly. And in this court ruling, it was over $1 million for one of the owners. And there was not a huge amount of income for these businesses. We're not talking like a $100 million business. We're talking less than $10 million in income. So if you get a judgment against you or your company, you want to pay back that deficiency, additional taxes, and penalties as soon as you can because of the interest that comes along with it. And if you don't know what deficiency is, it's how much taxes an individual should have paid as well as those individual penalties. So it's that discrepancy, that distance between, hey, we thought we were only being taxed on $100 in income, we're actually being taxed on $1,000 in income. That discrepancy, you have to pay that back as soon as possible. And documentation helps you move that forward much, much quicker and, move this audit faster so you can get that done and paid. You know what your actual liability is. And the last lesson learned here is that if you're going to work with a management company, then consider working with one that is not owned by you or anybody that is owning the dispensary, the cultivation, or the manufacturing business, right? Anyone that touches the cannabis plant should probably not be intermingling their interests in the management company, because this will show that there's a clear separation of interests and not some inseparable connection between the two entities or between the two businesses. And it's even better if that management company also services many other cannabis businesses. You don't want to have the IRS saying, hey, well, this management company, though it's not owned by anybody in the dispensary or anybody of financial interest in the dispensary, it still is fully and wholly dependent on the success of that one individual dispensary or that one individual cultivation. So just some thoughts there on lessons learned from this case. Now, we've discussed a lot of things here. It may have brought up more questions than answers, and I hope this presentation has brought you some value and understanding around that. But if you need help with developing a robust and effective tax strategy for your cannabis company, then please reach out to Green Growth CPAs via our website at greengrowthcpas.com or give us a call at 800-674-9050. We work with hundreds of cannabis businesses, from the small operator making $100,000 a year all the way to large publicly traded companies in Canada doing $50 to $100 million in revenue. We've seen a lot of different types of businesses in the cannabis industry, a lot of different strategies. We know what works, what doesn't work, what's iffy. We know how to guide you throughout your business, throughout the life of your business at the beginning, through those growth stages, and also through that exit, potentially even taking you public. So again, if you need help with developing a robust and effective tax strategy for your cannabis company, please reach out to Green Growth CPAs via our website at greengrowthcpas.com greengrowthcpas.com or give us a call at 800-674-9050. Have a great day, and we'll talk to you soon.